Welcome back to A to Z Equities, where we cover all US listed stocks from A to Z. Today we are discussing Applied Optoelectronics Inc., ticker AAOI. So we're going to be ranking this company on 5 different metrics: industry, price, growth, financial position, and management. And at the conclusion of the video, we're going to give a total blended score from 1 to 5 stars based on the average of the 5 metrics scored. So, with that said, let's get into it, starting with the company's investor relations page. So, what does this company do? Applied Optoelectronics Inc. is a prominent provider in the fiber optic networking sector dedicated to supplying reliable solutions, primarily in the cable, TV, internet data center, telecom, and broadband markets. So, in terms of what this business does, are very much focused on connectivity services for cable, internet, and telecom. Now, this company does not have a Wikipedia page. It's a smaller company. So, this is about as much information as we're going to get easily accessible on what the company does. So, in terms of ranking this company by industry, it's a well known fact that the cable TV industry is dying, it's going away slowly over time. And, bleeding subscribers. Clearly, that's not a good industry to be in. Internet data center, telecom. Telecom's a great industry to be in terms of the fact that it's cycle resistant, at least, meaning it's a very stable industry that doesn't really go through cyclical ups and downs. Obviously, internet data center sounds good, sounds like a growth industry to be in. And then fiber to the home, broadband internet. That's also obviously still a growth industry. And so the cable part sounds, not good, not the kind of industry you want to be in. The rest sounds good. So we're going to give this company 3 stars out of 5 for industry. So now moving on to the second category, which is price. And we're just going to be ranking this company on a number of different metrics relating to price. We're going to be calculating price to sales ratio, price to earnings ratio, similar ratios. So let's move over to Seeking Alpha, where we're going to use their tools to view this company's financials. First of all, before we start calculating the price ratios, what is the company's price? So as we see here, the company's market cap is close to 300 million, 297.65 million. That places it very comfortably in small cap territory. This is quite a small company. Now, we also see here, just interestingly, there's a lot of short interest on this company, 26% short interest. But that's not something that factors into our analysis. The shorts could be wrong, the longs could be wrong. We're just going to stay squarely focused on the categories that we're ranking this company on. So now that we know that the company's total price is 297.65 million, we can move over to the financials and start calculating these ratios. So on a trailing 12-month basis, the last 12 months that have been reported, this company generated $205.3 million in revenue. If we divide the company's market cap by 205.3 million, we get a price to sales ratio of 1.45. Not bad at all, 1.45 price to sales ratio. I would say that's on the better side. Now, moving down to the company's net income, we see that it's negative. It's consistently been negative all across here, going back to 2017 when the company was last profitable. That is interesting. We'll see whether maybe the cash flows tell a different story, but um, this is not looking good. This company hasn't been making money for a long time. The fact that it was making money prior, going back to 2015 to 2017, this company was making money, even decent money, especially compared to its market cap. 74 million versus its current market cap of 300 million. That would be a really good annual income number. But since then, they've just been losing money. No trend of improvement either, and maybe they're investing for the future. Who knows? We'll see whether this company is growing. We'll analyze that, whether it's growing on the top line, whether it's growing free cash flows, perhaps. But certainly the net income number is not improving, but more to the point for the price analysis, it's negative. So that is not a positive factor for this company. Now, moving over to the cash flow statement, let's see whether this company has positive free cash flows or how negative they might be. And we see in the trailing 12-month period, free cash flows are negative. 2023, slightly positive number. 2022, a little bit of a better number, 7.7 million in levered free cash flow. Prior to that, we had negative numbers for a number of years, a slight positive number in 2016. So the point being that this company is not free cash flow positive either. The free cash flow numbers do look better than the net income numbers, but nonetheless, these numbers do not look good. And if we were to go on a trailing 12-month basis, the price to free cash flow would actually be negative. So we're not going to calculate it. Now, let's move over to the balance sheet to see whether this company has a good price to book value, meaning the assets minus the liabilities of the company. Maybe there's a good price case there. So we see short term investments are actually way down, and that's something that's going to come into play, meaning cash, sorry, not short term investments, but cash, short term assets, way down. And that's something that's going to come into play when we analyze this company's financial position, but definitely worth noting that its current assets are way down. Maybe there's a similar downtrend in its current liabilities. In any event, 350 million in total assets here. Total liabilities are 155 million, so that actually looks pretty good. Total equity is 195.7 million. So that's a really good book value compared to the market cap. If we were to divide the $297.65 million market cap by the 195.7 million in book value, we get a 1.52 price to book ratio. That's a really good ratio. So let's just see about tangible book value. It's very close, but let's just run the numbers on it, meaning the tangible book value, which is the tangible assets of the company, which excludes goodwill from acquisitions as well as other intangible assets. That number is very close to the total book value, meaning that there's very little in intangible assets. But in any event, the price to tangible book value is 1.59, ticking up a tiny bit from the price to book value. But in any event, both the price to book and the price to tangible book value are very attractive here. So for price, to recap, the price to revenue, the price to sales looks pretty good. The price to earnings, not good at all. The price to free cash flow, a little bit better, but again, slightly negative on a trailing basis and definitely mostly negative going back over the last decade. The price to book value and the price to tangible book value look really attractive. So, overall, for price, not knowing anything yet about the growth trend of this company and just focusing solely on what the price looks like for this company, let's give them 3 stars. I'm thinking maybe 2.5 would be more appropriate, but based on the book value, I think that goes a long way in kind of shoring up this company. When you have a lot of tangible book value relative to the price, that's a real safety margin because those are assets that could be liquidated if needed. Those are assets that shareholders are the ultimate beneficiaries of. And although shareholders unfortunately don't always get to realize the benefit of those assets, nonetheless, in theory, those are assets that belong to the shareholders. That's important. So for price, we're going to give 3 stars. So now we're going to move on to growth and see how they're doing there. So returning to the income statement, let's see how the revenue is doing. So going back to 2014, to 2015, there was a huge jump. Maybe there was an acquisition there, or maybe they were just at a higher pace of growth at that point. 2015 to 2016, another huge jump. 2016 to 2017, I mean, they were growing by leaps and bounds during the middle of the 2010s. Uh, Going into 2018, I would think maybe there was a divestment or something, because then they really dropped off, unless they were just that affected by the cable industry starting to decline. Who knows what was going on here? 2019, another huge drop. 2020, back on the growth track, and they've just been, since then, they've kind of settled down. Since 2021, especially, they've jumped a little bit in 2022, down a little in 2023, definitely down on a trailing 12-month basis. So just over the last few years, kind of ignoring everything that came before 2020, 2021. Hard to tell what was going on there, but just looking at post 2020, this does not look like a good trend, because obviously the trend is downward. Downward trend has accelerated, it looks like, in 2024, down from 217.6 million last year. And some of that's obviously included in the trailing 12-month number. So it's a little shocking how much this has fallen. But again, looking at the company's history, it's not exactly shocking, because who really knows what's going on in terms of that growth trend. But all of that said, not looking too attractive in terms of price to sales growth. Now, we already noted that the net income of this company is negative, and we also noted that there's no trend of improvement here. They're pretty much losing 50 to 65 million a year, pretty consistently going back to 2019. So 55 to 66 million in annual losses. Yep. So basically, that's not going to factor in their favor. Let's just look back over at the free cash flow, which we saw, and see whether there's any kind of trend of improvement there, any kind of growth trend that could be helpful. And we see not really the case. Definitely improved since 2018 to 2020, but dipping back down to those levels now, actually, and certainly not improved from the last few years. Actually, quite a decline in the trailing 12-month period. So these growth numbers are not looking attractive at all. Lastly, and this could perhaps be the saving grace depending on what the numbers show, but we're going to look over at the analyst estimates for this company and see whether analysts see any growth in store for this company over the next couple of years. So this year, the EPS estimate is earnings per share estimate is negative 47 cents per share. That's a decline from the prior year. But then 2025, the three analysts covering this company expect 73 cents of earnings per share, which would give the company a price to earnings ratio of 10.43 at this price. But in any event, obviously, that would be spectacular growth. And on the revenue front, the company is expected to do 20% revenue growth this year, over 67% revenue growth next year. So I don't know where these analysts are getting this idea from. And I don't know if there's been an acquisition. We're not diving too deep into this company, obviously. We're just going through these metrics that we see here, especially on the financials. But in terms of what analysts think, and that's why it's important to look at the analyst estimates, because they're obviously a lot more dialed into the company than we're getting in this video. So, with all of that said, these analyst estimates obviously are extremely, extremely optimistic on both the revenue front and the earnings front. And for that reason, I was thinking this company might get 1.5 stars for growth, but we're going to hand them 2.5 stars for growth, because these analyst forecasts really indicate that there could be an acceleration, that there will almost certainly be an acceleration, because the analysts don't just come up with these numbers, pick them out of a hat. There's a reason why they think this. And whether or not these numbers get met, there's so much wiggle room here for the analysts to be wrong and for growth to still be strong moving forward. So even though growth has been very weak and actually non existent, both top line, bottom line, free cash flow, nonetheless, these numbers are looking really good for this company moving forward based on what the analysts think is going to happen. They definitely get some credit for that here in the growth category. So we're going to give them 2.5 stars for the growth metric. Now, moving on to financial position, we're going to take a look at back at the balance sheet to see how strong this company's financial position is. We already noted this is something that I couldn't help but notice when we were taking a look at the price. The cash has really dropped off. Cash in 2023, year end 2023, was 45 million. It's dropped off to 8 million. That is not a good sign. Receivables have ticked up, so that is good. Total current assets are down significantly. Looks like mainly because of the reduction in cash. Um, yeah, mainly because of the reduction in cash. Total current assets are way down. Those are assets that are short term in nature that could be tapped pretty much at any time or that are coming in within the next 12 months. In terms of long term assets, we see they've got a bunch of property, plant, and equipment, 400 mil, with a bunch of accumulated depreciation on that. So this is the value of those assets that's already been written off. So that brings us the net. Subtracting the depreciation from the gross PPE value gets us the net PPE value. We got a little bit of intangibles here, as we noted, pretty negligible. Total assets are 350 million, down again and again. That seems to just be based on the reduction of net cash. And it's not surprising that they're losing cash. We see they have negative free cash flow. They have very negative net income, but nonetheless, that's not a great sign to be down to so little in cash, because that would indicate that they may need to raise some cash. But all of that said, we see that the current assets are 133 million. Current liabilities are only 74.6 million. So that's a really good ratio. That's largely because their receivables are so much higher than their accounts payable. All of that said, they have very little in terms of the current portion of their long-term debt that's due. So their current ratio looks really good. Their inventory is a big piece of that. So, but their inventory is down from prior years, and that's actually a really good sign, because if a company has lower inventory than past years, it's more likely that they'll be able to move that inventory within the window that they within a short-term window, really. So that's inventory that they can monetize. If they had 110 million of inventory, which would be double what they have today, it might be a lot harder for them to move that inventory within a year, monetize it, and pay off their current liabilities. But since their inventory level is down, that they're more likely to be able to move that inventory, clear that inventory, and pay off their short-term liabilities. Their current ratio looks good. Current ratio is current assets divided by current liabilities. They've got a current ratio of close to 2, and that's pretty healthy. So, with that said, long-term debt is 76.3 million, not too high relative to their market cap, not too high, but relative to their earnings, obviously not as attractive because their earnings are negative. Their free cash flow is even to negative. So obviously, comparing a ratio of negative earnings to debt is never going to look good on paper. But that said, I don't think that relative to their market cap, their debt is too big of a burden. Um, Moving on to back to the income statement, let's just see. Lastly, this company's interest coverage ratio, or how much. Well, again, their interest coverage ratio is going to be negative because with negative earnings, any ratio that you compare that to is going to be negative. Any metric that you compare that to is going to be a negative ratio. But let's just see what their interest expense is. About 9 million a year. That's about 1/7 of their net loss. So not too bad. Not too bad. Looking at this from the financial position standpoint, again, the current ratio looks healthy. Long-term debt is not too high. Interest is also not crazy high, although one thing that we should note just before we give this rating in terms of financial position is that this 9 million of interest expense seems pretty high relative to the actual debt, right? Long-term debt is 76.3 million. They're paying 9 million on that. And I'm going to do the math on that real quick. 9 million divided into 76.3 million, that's almost a 12% interest rate. That's an 11.8% annualized interest rate. And I think that should weigh against this company because it shows that either their financial position is not seen as strong by creditors, or management has mismanaged its debt load and taken out a lot of high interest debt unnecessarily. Now, it's probably a combination of both because an 11.8% annual interest rate is really high. So it's probably a combination of both, and it's probably more an indictment of their financial position than management. But that said, I can't imagine that both don't play a role. It must be they've been raising money really recently, probably at high interest rates in this higher interest rate environment. But in any event, for financial position, so as we said, the current ratio looks fine. The long-term debt burden is not too high, but this interest number is looking a lot worse now. Again, they have negative earnings, so those ratios are just not going to look good if we compare their earnings to their debt or to their interest. So in terms of financial position, we're going to give them 2.5 stars because their current ratio looks fine and their long-term debt is not too high. I'm not going to deduct too much for the fact that they're paying such a high interest rate because, again, their debt is not so high relative to their market cap. I'm not going to deduct too much based on the fact that they have negative earnings because that really already comes off of the valuation. And also because analysts really expect those earnings to accelerate moving forward. So, with all of that said, financial position, 2.5 stars. Now, let's look lastly at management, give them a rating on that, and then move on to the total blended score. So, for management, first thing we're going to look at is how this company has performed versus expectations. So, we see here that on EPS, on earnings per share, the company has beat 8 out of 8 quarters in the last 2 years. On revenue, they've beat 5 times, missed 3 times. This is something that reflects favorably on management. If a company is regularly beating on earnings expectations, although obviously it's only based on the expectations. So, two companies with the same exact earnings could look very different in terms of beating versus missing on estimates if the estimates are different. But that said, a company that's beating on estimates is a sign of management managing expectations well, not overpromising and not giving the market too much false hope. So the fact that they've beat 8 out of 8 times on earnings in the last 8 quarters, very good sign. They've also beat on revenue 5 times versus missing 3 times. And that is a really good sign with regard to management. Now, let's also look at what this company's share count has been doing. Has the share count been going up or down? I would have a very hard time believing that it's been going down. And in fact, it has been going up pretty significantly, doubled since 2015, 2016, from about 17 million to 34 million shares currently. It's rising steadily year over year, and that is not such a good sign because that means that new shares are being issued, existing shareholders are being diluted, which reduces their ownership percentage in the company. Let's also look at whether this company has been issuing shares as stock-based compensation? And the answer is yes. Not surprisingly, the company has been issuing 10 million to a little over 10 million dollars worth of shares per year at a $300 million valuation. That equates to roughly a 3%, a little over 3% increase in shares per year, just based on issuing new shares to management. And so that's something that's going to weigh against them. So, in terms of the share count numbers, not looking good. In terms of the managing expectations, it is looking good. We're going to give them 2.5 stars 2.5 stars for management, just based on these handful of metrics that we looked at. Obviously, this is not a value judgment of the management team. This is just based on a few objective metrics that we could look at to just get a quick picture of kind of what management is doing based on some of these more objective metrics like share count and whether the company has beaten or fallen short of analyst estimates. So they get 2.5 stars for management. So to recap, Applied Optoelectronics Inc. got a 3 for industry, a 3 for price, a 2.5 for growth, 2.5 stars for financial position, and 2.5 stars for management. So the final total blended score on a scale from 1 to 5 stars for Applied Optoelectronics Inc. is 2.7 stars. 2.7 stars is the final score for Applied Optoelectronics Inc. Thank you so much for tuning in. Nothing in this video is financial advice. There's no buy or sell recommendation being made here. Thank you for tuning in, and we hope to see you back again on another video in the very near future.